Let's start off with our finance lease, and the theory and the journals go hand in hand for leases, ladies and gentlemen. Remember, with a finance lease, the risks and rewards are transferred, so therefore we are purchasing the asset and we have a corresponding liability, a lease liability, in order to fund this item. Okay, so initial recognition. On the day the lease actually happens, you enter into a lease agreement, and that lease agreement will discuss how long the lease is, when are the lease payments due, and how much those lease payments are. It should also specify what the rate implicit in the lease is. Okay, if it doesn't, you can calculate it from the cash flows. And we must also have a final lease payment, as well as what asset is actually being financed with the lease. So on initial recognition, obviously we will debit the asset, right? And we'll calculate the asset ex VAT. So the VAT is 14% of the asset, and then the lease liability comes up. And I've been a little silly, I put the working one in the wrong place. Actually, we need to work out the present value of the minimum lease payments. Okay, so all the payments due, remember that's going to be the 114, whereas the asset's on 100 and the VAT is 14. Okay, now the lease liability, we're going to have to do a calculation, and you'll have to use your financial calculator. You can do an amortization table, but that can take very long. You put in your future value, the payment, the interest, the number of periods, and you compute the present value. Sometimes you are given the present value, and you might have to work out, for instance, the future value, or the payment, or even the interest. Okay, so that's initial recognition. Learn that journal. Then we have our initial direct costs. Okay, these may be legal costs or brokerage commissions. Now we don't expense those. In terms of IAS 16 as well, it's a similar concept. We must capitalize all the costs to get the asset to the location and condition necessary for use. So I will debit the asset, and that may be PPE. And take note, please, I'm telling you every time the mapping, where it's got to go. Excuse me. So SFP is statement of financial position. Then there may be VAT on that asset, on the prepaid expense. This in essence is a prepaid expense. Okay, and you are going to debit the asset. So all I'm doing is capitalizing to the asset. Okay, so I capitalize it to the asset, and that would usually be PPE. And what will I do with that? I will treat it as a component of the asset of PPE, and I'll depreciate it, etc. Then we have our actual installments paid. And here you're going to have to use your time value of money calculator, okay, your financial calculator. And every time you make a payment, right, because you're going to have your amortization table made up of opening balance, the payment, which will then have the capital, which we call principal, and the interest to get a closing balance, right? And you'll have period 1, you'll have an opening balance. You'll then make a payment that is always the same. On that, you will calculate the interest. And against that interest, you will deduct from the payment, the balancing figure will be the capital. And you'll have your new closing balance. And the next period, you'll have your new closing balance, the payments exactly the same, and your capital and interest will need to be split. Okay, and remember, actually I'm working out on the opening balance, I calculate the interest, not on the payment. Okay, and you get your new closing balance. Now, why do a long table when you can use your financial calculator? Okay, so leave your working one figures in that you did up here. This is your working one figures. And in your calculator, all you're going to do is now use the amortization function, and you'll use period 1 to whatever it is. And you will compute the interest and the principal components, the principal and interest components year on year. And every time you do that, you'll need to pass a journal, right? And you will go and credit bank with the total payment. Okay, the installment paid. You will then debit lease liability to make it smaller with the principal component, the capital. And you will debit interest expense, take note, in profit or loss with the interest from that calculation. Now, sometimes on these installments paid, the installment payment date and the reporting date for accounting purposes are not the same. Then, if the reporting date does not equal the payment date, then you need to do what? You need to accrue for the interest, and you will go debit interest expense, profit or loss, credit interest accrual in the statement of financial position. Okay, and that will be based on whatever this interest calc was times x over 12 months. Okay, for instance. And you will raise the interest expense because we use the effective interest rate method. We still accrue for interest even if it's not paid. And then in the next year, what are you going to do? In the next year, you will reverse this journal. Okay, and then go back to recognizing the normal installments paid. So that you'll practice in a question. Okay, so that's the biggest part of the lease accounting. Now if we move down, we've still got an asset, right? And the asset will need to be depreciated. So I will debit depreciation in profit or loss, and you tell me it's in P&L, please. And I credit accumulated depreciation in the statement of financial position. Remember here, I need to take the original 100,000, and let's say we had another 10 rands worth of, 10 rands worth of initial direct costs, which are capitalized to PPE. Then I will take journal 1 plus journal 2, which was in my little numbers there 100, plus 10 gives me 114. And that 114 is what I'll use for my depreciation calc. So 114 times x over y depreciation. Okay, so remember to capitalize those initial direct costs. But then, when it comes to actually discussing the depreciation period, if ownership does not legally pass to the lessee at the end of the lease, remember, with a finance lease, ownership doesn't actually need to legally pass at the end of the lease. But the lease term could be for the majority of the economic life, and therefore we use up the assets anyway. Okay, then it's still a finance lease, and you're taking economic ownership. But what happens if ownership does not pass? Then I don't use the useful life. I use the lease term, not the useful life of the asset. That's important to note. Okay. Then, the last thing that I need to remember to do, and this, ladies and gentlemen, is actually purely a disclosure issue, is I must reflect the current portion of the lease liability. And that is the capital balance that is payable within the next financial year. Not the total payments, but only the capital component. Okay, the present value of those future payments in the next 12 months. And I will debit the lease liability non-current, because we assume everything's non-current up to now. And I'll credit the lease liability with the current component. Okay, so these journals you must learn: the initial recognition, the capitalization of initial direct costs, the installments paid, and remember you may have to accrue for interest if it's not coterminous with reporting date. Depreciate the asset in terms of IAS 16, but remember to capitalize the initial direct costs, and then reflect the current portion of the lease liability. Those are your finance lease journals and the theory. Learn it, make sure you understand it, because next up we're going to do some examples. Thank you.